There are many reasons to like Alibaba. They have the largest e-commerce customer base in China, with their Taobao and Tmall platforms being the most notable giants in the market. They have Alipay, which is a one-stop financial hub to manage all your bills, payments, and discretionary spending. They have Tainiao, which is one of the world's largest logistics networks that facilitates deliveries both within and beyond the borders of China. And perhaps most importantly, there is also their cloud computing segment, which many of the Alibaba Bulls believe is akin to the cloud-based offerings in the US, commonly described as the cash cows for giants such as Amazon and Microsoft that allow them to have as much money as they want to spend on investments and other things. With all the hype around the next Amazon of China, I decided to follow suit, jumping in for 100 shares of the company at a price of 216 Hong Kong dollars. And so far, the only thing I've been able to enjoy from that investment is a downward slide that is faster than any of the rides you can find in a Hong Kong amusement park, which actually doesn't say that much. Anyway, now that the stocks have plummeted down to these levels, the bulls of the company have become even more vocal about these once-in-a-lifetime bargains. For the most part, I've found myself to be quite persuaded by the argument, and I have also been slowly picking up more shares over time. But before I can truly commit myself into initiating the habit of dollar cost averaging into this company, I wanted to take a deeper look into the company's fundamentals. Specifically, I wanted to identify the most negative things I could find in their latest annual report, because no matter how good the good aspects of the business are, if you can't accept some of the flaws that they have, then you will not have the fortitude to hold on to these stocks during bad times such as this. So first on the chopping block are the overall financial results for their financial year of 2022. So note, unlike most other companies, Alibaba's financial year is measured across a different period. Their financial year for 2022 lasts from April 2021 all the way to the end of March of 2022. And let me first preface this by stating that the expectations for this financial year was never expected to be stellar. There is increased competition from JD.com and Pinduoduo. There is COVID, there is the war in Ukraine, and the repercussions from the zero COVID policy within China itself. So nobody was expecting to see the same growth that Alibaba saw in the early 2010s. This financial year marked the first ever decline in their earnings before interest, tax, and amortization, known as EBITDA, for their largest China commerce segment. This segment is really the only cash-generating segment for Alibaba, and it was definitely bad news for investors when they saw their first ever decline year over year. There isn't much else to be said at this juncture, as the future outlook for their earnings really depends on your expectations on the factors listed just now. As for the bottom line, the net income for their financial year was 61 billion renminbi, which was actually down 67% year over year. Interestingly, this was claimed to be due to decreases in market prices of our equity investments in publicly traded companies compared to net gains from these investments in the year before. Fortunately, because Alibaba is also listed on the US stock exchange, they are required to disclose all their equity investments in publicly traded companies, which I managed to find in the 13F filings. If we take a brief look into their equity holdings as of February 2022, which is around the end of their financial year, we can see that all of their holdings have experienced a recent decline in valuation, which explains the decrease in net income. However, it should be noted that many of these have also been seeing long-term downward trends as well. So it might not be prudent to expect that these will all go back up once the markets recover in the near future. And when they refer to their net gains from investments in the year before, looking at the same 13F filings from February of 2021 can show that they used to have the ownership of shares from Lyft and Groupon, which both coincidentally had their share price doubled throughout the course of the previous financial year. And the management team have since sold off their stakes in these two companies. But even if we exclude the change in value of all of these equity investments, Alibaba's net income in 2022 would still be down 21%. As for their non-GAAP income from operations, which is basically the income from operations Alibaba has calculated using parameters and metrics that it believes to be the most accurate for its business, after excluding some one-off items, this non-GAAP income was still down 33% year over year. This was claimed to be due to increased investment in Taobao Deals and Taobao, which essentially are budget-friendlier versions of Taobao and are part of Alibaba's response to Pinduoduo's dominance in the lower income demographics. If we look at the quarterly growth in the number of annual active customers on Taobao Deals since its inception in 2020, we can see that it has seen healthy double-digit growth quarter over quarter compared to the smaller single-digit pace that Pinduoduo has been growing at. We can also see that the rate of growth of Taobao Deals has also been slowing down over the past year, with them sitting at 300 million annual active customers at the moment. This makes it unlikely that Alibaba will be able to become a greater competitor to Pinduoduo with its current trajectory of growth, who on the other hand currently have near to 900 million annual active customers. Next is the cloud computing segment. Alibaba is currently the largest cloud computing provider in China and also sits in the top 5 across the globe. The good news is that this segment of the business has been able to turn a positive earnings since it was founded all the way back from 2009. There are also expectations that it will become a stable cash-generating business within the near future. However, when comparing revenue growth in this segment in the first quarter of the calendar year of 2022 compared to its major competitors, have shown that its results aren't as promising as they might seem. When we zoom out to look at the results from this segment across the whole financial year, the revenue in the cloud segment was able to grow at 23%, which would have been 29% if they excluded the revenue that was once originating from their largest customer, TikTok, who have since moved to a different cloud provider because of regulatory issues. The good news now that TikTok is gone is that the customer base for the cloud segment is now more diversified than ever, with the next top 10 customers contributing to less than 10% of the cloud's total revenue, meaning that a loss in any of these customers is unlikely to have a significant impact on the segment as a whole. As a company matures, one would expect the cost to come down and for margins to increase, as the logistics and the efficiency in which a company is run gradually improves. This has not been the case. While the net income for Alibaba has grown at a compounded annualized growth rate of 7.6% in the last 5 years, their cost of revenue has grown at 55% per year. The main reason for this is that Alibaba is trying to grow its new retail ecosystem, which consists of many brick and mortar stores being operated to help achieve their goal of streamlining both online and offline retail together. The decision to operate more in-person stores will inevitably drive up the cost of revenue, as they now have to account for and store for their own inventory. This can be seen in the increase in the cost of revenue as a percentage of total revenue over the last few years. Therefore, one should expect that the profit margins of the business should not be at the levels that it used to be anymore. All of this has helped them grow their direct sales business at an annual growth rate of 86% over the last 4 years, which is currently their fastest growing segment. As for international retail commerce, Alibaba, like many, see the huge potential in e-commerce in the Southeast Asian area, which has been predicted to grow to a market size of around $700 billion to $1 trillion by 2030. This has led Alibaba to acquire the then largest e-commerce platform in Southeast Asia, called Lazada, in 2016, in its attempt to seize this market. This region is highly competitive, with different countries showing preferences to many different e-commerce platforms that operate within the region. In the first quarter of calendar year 2022, although Lazada was able to achieve an order growth of 32% year over year, the results from their biggest competitor, Shopee, had even more stellar results, who had their orders grow at a rate of 71%. Shopee is owned by a Singaporean holding company called Sea Limited, which Tencent has a small stake in. Their app was found to be the top-ranked app in the shopping category by downloads in the same quarter. The inferiority in the results by Lazada compared to Shopee has been mainly attributed to its management, which apparently have underwent a poor transition from its previous owner to Alibaba, which gave Shopee and other competitors who were once smaller in scale time to lure vendors and buyers to its side. Finally, despite Alibaba generating massive amounts of cash flow from its China retail commerce segment, other segments such as international commerce, Cainiao logistics, and local customer services have been suffering from increased losses as they continue to expand. Many of the justifications by the management team in Alibaba for these increased losses have been due to their increase in marketing and spending for user acquisition and investment into infrastructure. As a whole, it appears that Alibaba has identified a lot of good opportunities that it wants to take part in. These areas that the company is investing into all appear to have synergy with each other, meaning that if they can all succeed in being successfully set up, they can help Alibaba form a strong self-reinforcing ecosystem which can act as a moat that many of its competitors can only dream of attaining. This reminds me heavily of the ecosystem that Apple has developed for its products, which make it very hard for competitors to stand out when there is so much synergy between different segments. The question now is, with so many competitors that are solely focused on just one of the many segments that Alibaba is operating in, will Alibaba be able to outperform each of them while still trying to expand and focus on so many different things at the same time?